Okay, so we're looking at the payback method with different depreciation methods because we know that depreciation affects our cash flow amounts when we're doing our estimated annual cash flows in order to make capital investment decisions. So we're looking at a piece of equipment that can be purchased for $150,000. The first thing that we're going to look at is straight line depreciation, 5-year life and 0 salvage value. So if you take 150,000 and divide it by 3, you get depreciation of $30,000. And that's every year for the entire 5 years. So this first example is for straight line depreciation. Our year 0 in capital budgeting decisions is year 0 is the year that you put the money out. So in year 0, we pay $150,000. We're trying to determine when we get that investment back. So we're calculating what our positive cash inflows are for the remaining period. We have our net income amounts from this table, and we are adding depreciation back to net income. Then we're going to calculate when this gets paid back. So we have our payment of $150,000, and we are going to add each year's cash inflows. We know that it's going to get paid back sometime in year 3. So when we need to calculate a partial year, we take the remaining amount. So we have $55,000 left at the end of year 2, divided by the cash flows that happen in year 3. Put too many zeros in there. Okay. So it's 0.6875. So the payback period using straight line depreciation is 3.6875 years. 2. Okay. Then we're going to look at it using the double declining depreciation. So we're going to take the same information, and I'm just going to copy it lower. And we're going to change the depreciation amount. So when we take double declining, we take 100% divided by 5, and that equals, equal sign, 20%. We take 20% times 2 to get the double declining depreciation, and our depreciation each year is 40% of the book value. So we need to know our beginning book value in order to calculate our depreciation. So let's do each year depreciation. Just a refresher on calculating depreciation. Make this all fit on this one screen for you. So the first year, that piece of equipment is worth $150,000. Take that value times 0.4 for our depreciation amount, because we calculated 100% divided by 5 years is 20%, times 2 is 40%. That's our double declining depreciation. So our accumulated depreciation then is $60,000. And our ending book value is our beginning book value minus the accumulated depreciation. And we continue that for each year. You know that we can't depreciate it below salvage value, which is 0. So we're only going to depreciate it to the point that we have a 0 value. So in year 5, we can only depreciate it for the book value, giving us an ending book value of 0. Now we have our depreciation every year for the double declining balance that we can pop into our original table and calculate our payback here. So we know again that that payback is going to happen sometime between year 2 and 3. So we're going to take the remaining leftover, that 19,000 from year 2, and divide it by our net cash flows for year 3, which is 71,600. Now we get 0.265. So our payback period using double declining is 2.265 years. Because double declining depreciates faster in earlier years and it's a non-cash expense, we increase the amount of cash inflows during those first couple of years, which gives us a slightly faster payback. The next way that we can analyze our types of payback is return on average investment, or its ROI. So this is a percentage of the amount invested. So if we use straight line depreciation, we know that the carrying value of an asset decreases uniformly over the asset's life. Therefore, if the salvage value is 0, the carrying value or average investment is just 1/2 of the asset's original cost at any given time. So that's our average investment. So we take our net income divided by our average investment. So when we're trying to compute our average investment, we can see the calculation here. So we have our original cost plus salvage value divided by 2. So we have this piece of equipment. We're back to our example with the baseball team. So we have 10 new vending machines. They have an average investment of $75,000. They have a total salvage value of $5,000. If we divide that by 2, we end up with $40,000. And we had already our average estimated net income was $10,000. So if we take $10,000 and divide that by our average investment of $40,000, we get an ROI on this project of 25%. Do we know whether or not a 25% is a good return? Well, we have to know some other things. So we would have to know what's our average return from our other investment opportunities. Do we have a minimum required rate of return? What is our cost of capital? And some other information. So when we're looking at this average rate of return, we're trying to compare these two. So we have our cost of investment, our estimated salvage value, and the average estimated net income. So first, to calculate our average investment, we take the original cost plus the salvage value and divide by 2. So for the ROI, so we have project 1 and project 2 here. And we're looking at the ROI, or the return on average investment. So that calculation is taking the average estimated net income, so 20,000, and then we're going to divide it by our average investment. So we take 90,000 plus 10,000 and divide that by 2. We get approximately 44% return on investment. We can also do the same for our average 8,000 divided by, I'm going to take that 65 plus the 15, divide that by 2, and we get a 20% return. So we know that project 1 has a better return on investment than project 2. So the return on investment has a common weakness with the payback period. It doesn't take into account the present value of the investment by looking at the cash flows. So we know when we talk about the present value of money or the time value of money that the future value of $1 is what we're looking at. And so in our next examples, we're going to take into consideration that time value of money. So we need to look at when those cash receipts happen, the purchase price of the investment, if it has to be paid in advance or if installments, and other considerations. And we'll look at those in the next video.